Rich Uncles. 5 years ago, I posted my first of 2 video reviews about Rich Uncles radio commercials. And what was I warning you people about? That these non-traded REITs, when they paint this picture that a non-traded REIT is not subject to stock market volatility, it's a misdirection. You can't measure the volatility of these things just because they don't trade. Non-traded REITs do not live in an alternate real estate investment return universe. With any investment that pays out a higher yield, with higher yield comes greater risk. It's just that simple. And so I was saying, don't invest in a non-traded REIT thinking that I'm getting the 7.5% annual dividend, and at the same time, you're insulated from volatility? It doesn't work that way. And if you're borrowing money from a bank to fund the purchase of properties, you're amplifying risk. And so what can go wrong with a non-traded REIT? A real estate recession. 14 years ago, it was the toxic loans that caused the 2006 housing crisis. And in 2020, it's coronavirus. Now, Rich Uncles has several REITs. One is this BRIX REIT that owns student housing. Just when you thought nothing can go wrong, schools are all shut down. 24-Hour Fitness, they filed for bankruptcy. Also a property leased by Starbucks. So basically, I guess nobody's paying rent. And when this happens, it also causes the underlying value of real estate to go down. But basically, this BRIX REIT, just like that, lost 93% in value. The underlying value of investors' principal lost 93%. Has the stock market dropped 93%? At the moment, the S&P 500 index for the year is up slightly. And how about if you were insistent about investing in real estate? So if you invested in a very well-diversified index fund like VNQ, it's only down 12% for the year. Over the last 2 years, it's down about 2%. Yeah, it only pays currently a 3.96% dividend, but at least you didn't lose 93%. Now, going back 5 years ago, I think Rich Uncles had what they called REIT 1, which in January of 2019, they suspended redemptions for. Just because they start out giving you the right to cash out doesn't mean that they can't amend that rule as they please. And so you just have to go into these non-traded REITs with a mindset that your money will be stuck in there for years. But so then, I guess in late 2019 or early 2020, Rich Uncles REIT 1 merged with RW Holdings NNN REIT. Well, now I'm reading online that this merged REIT has lost 30%, down to $7 a share. And I don't know if this means that the original Rich Uncles shareholders have gone from $10, a $10 offering price to $7. But I guess that's what's happened. Also, they dropped the dividend rate to 35 cents a share. So instead of getting the original 7.5% or whatever it was, now you're getting 3.5%, which is now less than what the real estate index fund VNQ is currently paying. But so hypothetical, let's just assume that someone invested 5 years ago in Rich Uncles REIT 1 and earned 7.5% per year, but now they've lost 30% of their share value. Again, I'm assuming that's what's happened here. What would be their annualized return on investment? And how is it compared to the S&P 500 index as well as to Vanguard's real estate index fund VNQ? So with this 30% hit, your annualized return on investment is just 0.75%. So after all the risk you took, all you got rewarded with was CD-like returns. How about Vanguard's well-diversified real estate index fund that only pays currently a 3.96% dividend? And I'll assume for this example that they paid 3.96% in previous years. You've earned 3.9% per year. You see, now this is starting to fit closely to the study that found that non-traded REITs underperform comparable publicly traded REITs by about 1.4% per year. And finally, what if you invested in a plain old S&P 500 index fund, just like Warren Buffett always says to do? Your annualized return on investment has been 10.35% per year. But anyway, so much for the foolproof feature of having triple net leases. 24-Hour Fitness sure doesn't care. But I'm just an average Joe investor with nothing to sell, but who has done his homework about investing. And I was criticized way back when by none other than the promoter of Rich Uncles himself in the YouTube comment section. And he was saying that only a fool reads generalized information in order to formulate an opinion about a specific investment. Yeah, famous last words.